Hello, my name is Rick Dunnett, and I'm here to give a rather high-level discussion on Social Security benefit options. So we're going to go through a PowerPoint rather quickly, just for the reason of time. We offer further deeper dive discussions into topics like Social Security and Medicare and in tax and retirement. However, for the basis of this presentation, we just want to touch on real quickly, and to be honest with you, just kind of show you the complexity and basically pave the way to basically understand the questions that should be asked before you go down this path. There's a number of situations that really require some professional assistance in making sure you may be doing some of these things right. A lot of these decisions become very permanent and they could become very costly. So again, this is the purpose of this quick, 15-minute PowerPoint, seminar that I'm walking you through is just really to raise the questions and make sure that you understand the complexities before you go down this path. So we'll get started here. Again, my name is Rick Dunnett. I've been at Hammer Financial for nearly 4 years now. I've worked in the financial markets most of my career. I have a pretty good grasp of what is happening when it comes to income planning. So getting right into it, what is Social Security to the average earner? Well, just so you're aware, for most people, the 40% of their income in retirement comes from Social Security. Obviously, if you make more money or you've saved more and you have a higher expenditure, that number would be smaller. But on average, it's 40%. It was never meant to be the sole source of income for people in retirement. So how complex is Social Security? Well, there's 81 age combinations, 567 different sets of calculations. And again, the simplicity is an error in making the decisions can easily cost you $100,000. You'll see a number of examples as we go. But again, I'm going to try to move through this pretty quick, and it's, to be redundant, if you need a deeper dive, we can get into that at a later date. Will Social Security be there for you? I'm sure everybody has heard this. I mean, when I'm speaking in front of an audience, I ask, how many people have been told, I'm going to go get my Social Security before it's broke and before it's not there. Well, that's not quite how it works. Social Security is a pay-as-you-go system. The money that's been coming out of your paychecks hasn't gone into an account with your name on it for the point when you retire. Basically, those people that are currently on benefit are getting their benefits paid by those still working. Back when Social Security started in 1935, there were approximately 20 people working to every one person on benefit. Nowadays, there's about 4. So everyone likely has seen letters such as this. Everyone's got a junk drawer, probably a couple of these in there. And starting in 2009, they basically said that by 2041, you're going to get about 76 cents on the dollar. One of the keys about all these letters is they basically say with reform. Now, I'd ask you a question. Is there reform being done? Of course there is. Retirement used to be at 65. Now it's 66, 67, it's 2 months, 4 months, 6 months. The amount of money they were able to take out of your check basically used to be capped at a very much lower number, around 30,000. Now it's over 100,000. Additionally, there's a number of different claiming strategies that have been proven to be quite lucrative, have now been phased out. So is Social Security being reformed? Absolutely. And so a lot of this is being done to basically make sure that it does stay around. But you'll see that there are several of these letters after a couple of years. I mean, the very next year, 2010, they said in 2037, so they bumped us forward a few years. Not to be outdone, by 2014, they said, okay, now we're back up to 77 cents, but that's it by 2033. So again, this is a hot potato. This thing's moving and they keep changing it. But for the most part, what they're trying to do is just find more ways to feed this program or to fund the programs. So does anyone ever know who this woman is? I make the joke about this woman when I'm speaking in front of audiences. I call her, there's the gentleman who participates in the hot dog eating contest and around 4th of July. His name is Chestnut. This woman is the first woman who has ever collected a Social Security check. She put about $25 into the program, and she started taking her, getting her benefits. She lived to be 100. She took nearly $23,000 out in benefits, and she only paid in about 25%. So as Joey Chestnut is the example of basically one of the, a record holder, this woman paid $25 into a government program and managed to pull nearly $23,000 out. So is the system flawed? Absolutely. This was proof of it. Truthfully, the very first person who was entitled and started drawing her paychecks basically beat the system. And so will it be enough? What other income sources will you have when you retire? And are any of these sources guaranteed to provide income through retirement? So this is a very important distinction we'd like to make sure our clients are aware of, because if whatever sources aren't guaranteed means that they're not guaranteed, which is the stock market, which is a very hard way to go through retirement, depending upon the performance of the stock market as to whether or not you have money. So one of the things as planners that we do is we want to measure how to best claim your benefits alongside the other resources you have, and how we put together a plan that best suits you. So what is the number one question asked by retirees? Will I outlive my money? 54% of people right now are worried about whether or not they will have the necessary money to live in retirement. So that basically shows that if this is a concern of yours, you're not alone. How much do you really have? What is the number that you need? So the three pieces of Social Security, benefit option puzzle we're going to talk about today is going to be determining what your Social Security benefits will be, understanding what options are available to you, maximizing your lifetime benefit. So everyone, I'm sure, has seen these statements. They are not coming as frequent as they used to. One of the things is that by 2025, they are expected to be closing all of the Social Security offices and basically forcing people to go online. So it's important that everyone kind of understand and gets familiar with the system. You're going to see these statements, learn how to go online and to determine what your benefits are, making sure that they have properly recorded what you've been paying in for years. Okay, it's not uncommon that there is a zero in the middle of your work history when you know for certain that you did work that year. So we just want to make sure that it's all there. So here's a couple of the terms that are important to understand: eligible versus entitled. WEP and GPO, which stands for the windfall elimination and the government pension offset. The cost of living adjustments, claiming age, working after making your claim, taxation, spousal benefits, and common claiming strategies. So first of all, eligible versus entitled. Basically, in order to be eligible, it basically means you're 62 years old and you've earned the minimum number of credits, which is 40 credits. So the idea is that you basically work for 10 complete years for the most part in order to qualify on your own record. Next, entitled. This is somebody who is not only eligible, but they've also applied for their benefits. Whether or not they're receiving them at this point doesn't matter, but they have they are entitled and they have in fact applied for their benefits. So the windfall elimination, the government pension offset, what both of these are basically in relation to is whether or not you were working for a federal, state, or local government where Social Security taxes were not taken out of your paycheck, such as like government agencies or an overseas employer. But if you then did continue to work long enough for companies that did take Social Security benefits out, a modified formula will be used to determine what sort of benefits that you would get. So when we talk about the government pension offset, this generally is dealing with the spouse's widow or the widow's benefits. And again, we get more into that if you should have any questions about it. The cost of living adjustment, this is basically, the raise that you get from Social Security over the years. And basically it's provided an inflation hedge. And you'll see that pretty much every year there has been a raise. There wasn't one raise in 2016 is the only year there wasn't any raise at all. But for the most part, as planners, we like to use that 2% or 2.5% cost of living adjustment. We don't really want to go too much beyond that. Next, claiming ages. There's ages you can claim. 62 is the very earliest you can claim. And then full retirement age, also known as FRA, is for people that are 66. Those are those born between 43 and 59, and age 67, which is age 60 or later. The reason you don't see a 65 anymore is these people are already on benefit. And so when it comes to the benefits of when you should claim, the pros, obviously the pro of claiming early is pretty simple, right? You start receiving a check earlier. But then what becomes the negative in that? Because a lot of people think, yeah, there's money, I'm going to turn it on. And, if I have a job that I'm working, I can kind of double dip. Well, a lot of people don't realize that there's rules about how much money you can make on Social Security. So it's a good reason that you're watching this. If you have further questions, you should ask before you think you'd be able to simply just double dip. But the negative in starting early is it's the smallest check you'll have, and there could be a possible reduction again or penalty if you are employed. As far as full retirement age, the benefit is there's a higher monthly check. There's no penalty at all if you're employed. The negative there, well, there's no benefits from age 62 to that point. So, but it makes sense. But keep in mind, all the time beyond age 62, when you are deferring, your pension or the Social Security benefit amount is always increasing. The benefit of waiting till 70, well, this is the highest monthly check you'll get. There's absolutely no penalty if you're employed. And as you probably have seen the trend and would understand that there's no benefit for you from age 62 to 70. But what's key to understand from full retirement age to age 70, that your PIA, your primary insurance amount, this is the amount that actually they use to calculate your benefit. That benefit will increase by 8% a year for a total of 32% by age 70. There's absolutely no reason whatsoever that if you turn 70 years old and haven't turned on your Social Security, that you shouldn't. You should absolutely turn on your benefit by 70. There's no reason not to. Some important definitions to understand is deemed filing. This requires that a claimant file for any of their benefits before their full retirement. They must have all their benefits available to them at this time. So basically what this is saying is, if you haven't reached full retirement age, your options on how you choose to begin your benefits and in your strategy really becomes limited. So, rather than sound like a broken record, should you choose to take your benefits early, you're going to find out over the next handful of slides that you are forever limiting to how much money that you will be getting from turning your benefits on. So if at all possible, and understanding that it isn't always possible, some people don't have very strong health, or they worked in the trades and their bodies simply won't allow them to keep working. It's understandable. Everyone has their own unique situation, but it's important to understand you're making the decision based off the information that is correct. Restricted application is available for workers who have reached full retirement age, which allows them to restrict their application to only a spousal. So again, because they waited for full retirement age, supposing the husband is going to continue to work and he doesn't necessarily want to take his benefits, but he's going to apply for his, he's going to restrict it. That lets his wife, who maybe she didn't work or she doesn't have nearly a very strong benefit, that she can move into his and claim a spousal. Very simple. Next, voluntary suspension. This is available to workers who, once again, have reached full retirement age. Once they get to full retirement age, they would suspend their benefits, which would allow them to continue to grow. So maybe that gentleman decided or a woman decided they wanted to start taking their benefits, and they were still receiving quite a bit of money at work. And they thought, you know what, if I don't necessarily need all this money. If I wait and decide to turn it off, I don't have to be worried about taking this money and investing it. It would be growing at an 8% per annum in the background. So a lot of people would decide that after they've already started making their decision. And one thing about it, the spouses cannot collect against a suspended benefit. So just be aware of these before you make the decision. So how will working impact your Social Security benefits? So this goes back to the question of the person who thinks, you know what, I'm going to double dip. I'm going to turn on my Social Security because work around the water cooler with Social Security is going away. So I'm going to start collecting my benefits while I still can. Well, so we understand this. If you take before full retirement age, you are permitted a threshold of $19,560 that you're able to earn. Once you go beyond that threshold, for every $2 you're over, you have to give back one of your dollars of benefit. So this is the proverbial 2 steps forward, 1 step back. That you're given a $19,560 as kind of a buffer, as a threshold. But once you go beyond that, then you start having a reduction. So if you reach your full retirement age, but not necessarily full retirement, such as 67 and 2 months, 4 months, and so on, but you're at least at the age of full retirement, they will let you then earn the threshold of $51,560. Once you go beyond that threshold, now for every $3 you're over, they will restrict $1 of your benefit back. So much better than the 62, but you're still, if you're a high income earner, that whether or not you have your income turned on by this point may be counterproductive. And finally, if you're after full retirement age, there's no limits on your earnings. You can make as much money as you want, and better yet, there is no reduction at all on your earnings. And again, that's why you would want to do that. Obviously, taxation becomes an issue, which brings us perfectly to the next topic, provisional income. A lot of people have no idea what this is. What provisional income is, and I guess I could ask it another way, is your Social Security tax? And the question, is it taxable? And the answer is yes, but it doesn't necessarily need to be if you have done the proper planning. At least, that you can mitigate quite a bit of this. So what provisional income is, it's a simple formula. It's 1/2 of your total household income. I'm sorry, 1/2 of your total Social Security benefit. So supposing you're getting 40,000, half of it's 20, and everything else that hits your tax return, ordinary income, dividends and capital gains, non-taxable interest, all of these items, once they hit your tax return, added to 50% of the benefit, will then bring you up to a threshold. So what are these thresholds? As a single filer, it's 25,000 is the first threshold. As a joint filer, it's 32. For the point of this discussion, we'll use the 32%. So what this provisional income is saying, once you go over 32%, 50 cents of every dollar you're over of your Social Security will now be taxed. And that'll continue up until you get over 44. Once you get over 44, there's going to be an additional 35 cents. So 50 and 35 reaches this 85 of your Social Security being taxed, to a maximum total amount of 85% of your total Social Security benefit. They cannot tax you beyond 85%. So what this looks like, it's so the example. So if we had $50,000, and looking at that first threshold, 50,000 was your income. We take out that first threshold at 32,000. That means you're over that threshold by 18,000. 18,000 at that 0.5 is $9,000. Very simple math. Now we're going to look at, because that 50,000 is also more than the 44, which is the second threshold, you'll see you're 6,000 over. So then that 6,000 times 35 cents is 2,100. So in this tax example, there's a total of 11,100, or 55% of this current example of what otherwise was non-taxable Social Security was in fact made taxable. So looking at this a second way, again, when we speak about provisional income, here we are, $20,000 of Social Security and $40,000 worth of IRA withdrawal. This was the same amount of money as we previously had, but the provisional income on this is 50,000. So 50 minus the 32,000, I'm sorry, 50 minus the 32,000 was 18. Our slides here were ran twice. Forgive me 1 second, folks. Going back to the beginning, if you had $20,000 in Social Security and 40,000 of IRA withdrawal, you'll see that's 60,000 in real money, but provisional income it's only 50, because half of 20 is 10 plus 40 is 50. The second example, there's 40,000 is of Social Security, 20,000 of IRA withdrawal. It's still $60,000 in real money, but provisional income, this is 40. Half of 40 is 20, and 20 more is 40. In the second example, 40 minus 32 is 8,000. 8,000 at 50 cents on the dollar is 4,000. You never went over the second threshold, so the total amount of tax in this example is only 4,000, or about 10%. So what does this mean on the tax return? Well, you're going to see that the 11,000 in the first example, 11,100 on top of $40,000 of withdrawal is a total of 51,100, minus your standard deductions is 27,800, means you have taxable income of 23,200, and you go through the brackets, you're going to pay just under $2,400. If we look at the second example, with a little bit of planning, that 4,000 of total taxable, total Social Security being taxed, $20,000 in distributions is a total of 24,000. The standard deduction completely wipes out all of your income, so you pay no income tax. So it's just a very neat thing to think about. If all that you had was Social Security and Roth IRAs, basically you wouldn't have any income tax at all. So when should you start taking your Social Security benefits? Well, this is where kind of at the beginning I mentioned, everyone is unique. Some people have saved better. Some people have different plans. They have different legacy concerns. They have different health. They may have overall just different longevity that they should have. They expect to live for quite a number of years, which, that's where you really want to hope that you can do some proper planning. Obviously, again, as I said, for those that maybe worked in the trades or you just had poor health, maybe it makes sense just to turn it on and start collecting the benefit. But again, it probably makes sense is that if you saved well, to have meet with a professional or someone who understands this to help guide you through to create the best overall outcome. So, do you start by delaying your Social Security and drawing from your assets, or turning the Social Security on? I think you need to provide more information to get a better answer. So how would you reduce or eliminate the tax on Social Security and income? And again, it's kind of difficult to say this for people who are already turning it on, but these are the thoughts that should go through your head on how you might be able to better manage your tax. Again, once the tax money's taken, that money's gone forever. It's different during the accumulation phase than in the retirement phase. In the retirement phase, you want to make sure you can manage that tax. Those dollars you save go on to make more dollars and to help continue your plan or your legacy planning. If tax money is automatically gone, so what you can do to better it, obviously, is the key here. So you can postpone your Social Security. That would definitely delay the taxes. You can reduce other sources calculated in the provisional income, which is your wages, distributions, interest, and dividends, how you're currently invested, how much of that money is actually making its way onto your tax return. Again, these are things that we look at every day in order to mitigate the taxes for how much is not only hitting the return, but how much it's dragging your Social Security further taxable. So some important aspects to know about the spousal benefits. In order to claim a spousal benefit, you must be at least 62 years old or have a qualifying child, basically a special needs child. In order to have a spousal benefit before you reach your full retirement age, you do that, your benefit, if you're claiming before you reach full retirement age, your benefit will be permanently reduced, again, unless you have that qualifying child. If you claim spousal before you reach your full retirement age, you will not be able to switch to your own retirement benefit at a later date. So as I said earlier on, the decision becomes very, very final very quickly once you start taking your benefits early. Your options remain open to do better things if you wait till full retirement age. Now, if you are divorced, you may be entitled to a spousal benefit if you're at least 62 years old, you were married 10 years continuously, and you remain unmarried. Obviously, if you are to get married now, you're going to be on your new spouses. Your ex-spouse must be entitled on their own. So as survivor benefits, now there's been a lot of changes in a lot of the different rules around Social Security. Well, one of the areas that we feel that they have done the right thing is spousal benefits, protecting those who had a spouse pass away. So if you are a widow and eligible to collect either your own benefit or 100% of your spouse's benefit, whichever is greater, you must be at least 60. There is a reduced benefit, however, prior to full retirement age. You must have been married for at least 9 months or 10 years if divorced. And you must also remain unmarried until age 60. And that's all part of the Bipartisan Budget Act of 2015. In order to maximize lifetime or Social Security benefit is critical, it's important to know that there's about 90,000 centenarians, meaning those over 100 in our society today. This number has grown tremendously over the past few years. Not so surprising. The majority of these women, about 80, almost 83%, are women. But to show that once the couple makes it into their 60s, the longevity, men are living till 83 and women are living to 85. So that really shows a lot of longevity and the reasons for planning. So if you looked at it from the standpoint of couples, if you have a 50% chance that one of you, if you're making to your 60 or 65, 50% chance one of you would make it to 92, 25% to 97, and 10% that you would join the Centenarians Club. So again, important to understand the magnitude of the decision. The do-over reset strategy, I'm going to try to move quickly through these. It's something you can do once in a lifetime. For you golfers out there, this is the mulligan. You must request it within 1 year of your initial claimant or benefit. You pay back all the money. Every dime they've given you, you pay it back. You file a Form 521. That's a request for withdrawal of application. It's like it never happened. You go right back into having your benefit continue to grow. Again, you're only able to do this one time. A start, stop, restart strategy. This is a voluntary suspension. This is for those who, again, key is reach full retirement age. And then you can restart at any time. Your benefits grow by 8% until age 70. There's up to 32%. There's no reason beyond 70 that you should delay. And so now what we want to do is say, will I outlive my money? How do I protect myself? 44%, of baby boomers and Gen Xers are projected to lack adequate savings. So it's a big concern. It's very important that people start looking at this and start finding these answers and planning before they just decide to go into retirement and turning it on. So what we want to do is determine a strategy that begins with asking, how much money do you need? That's a very pertinent discussion to have. Of course, you'd want as much as possible, but of course, everyone has resources. Now we got to figure out a distribution plan that'll last you not only at the beginning of your retirement age, but what if you lived to 100? How do you make sure that there's still money? How do you make sure that your assets are properly going to make it down to your children and they aren't necessarily going to end up being garnished by the IRS? So how do we close the gap between the income you have and the income you need? One of the things that we do here is very simple. We have what's known as our bucket plan. There's a book for it available upon request. We can send it to you free of charge. It's as simple as it is. It's probably one of the more brilliant strategies that we're able to create an income plan for people and protect them through retirement. Again, they do have to have some savings, but we're able to structure that much better. So now, sooner or later, now is basically money. It's planned expenses, maybe a magic number you had in your head that you always want to make sure that money's available at your fingertips. The soon bucket is kind of where the rubber meets the road in the planning. This is where we want to figure out how much money it is you need a month. And we want to carry this out for a 10-year period and have that money properly invested in the soon bucket so that regardless of what happens in the stock market, you will have that 10 years of income basically as a guaranteed source coming. Which then allows us, if you have a properly funded now bucket or soon bucket, now it lets you invest for growth in the later bucket. Because again, if you have these, you have a time horizon now that you're not going to be forced to pull money out of your later bucket when the market is down. That's called the sequence of returns risk. I highly encourage all of you to look that up. Again, sequence of returns risk. It's what we need to avoid. It's how you can implode your retirement. So with that being said, I just want to wrap it up. I know I went a little bit longer than I initially stated, but overall, if you have any questions, there is a longer version of this we can send, or we're open for more just conversations if that's a better way to go through it, if you have questions. But feel free to reach out, set up a call at no charge to go through some of these. And again, if you'd just like to request the bucket plan book, we're able to provide you that as well. So thank you very much for attending. Bye-bye.